you made reference to the 69 Act as being a grand bargain, which many do. The '06 pension, do I have the right year?
Yeah,
Pension Protection
2006.
Act. You also call that a bargain. Uh,
Yeah.
did DAF providers get a better bargain out of the Pension Protection Act than private foundations did out of the 69 Tax Reform Act?
Yeah. I mean, well, so there's this little irony. I don't know if it's an irony. There's this little detail that I want to be sure that I highlight. But in general, what DAF providers got was more of the benefits and fewer of the restrictions than apply to private foundations. And let me just use one example, which is a little weirdly complicated, but it really illustrates a very important benefit for donor advised funds. And this is one for which there is data. So when you contribute property to a charity, generally you contribute that property at its fair market value. So, like if I donate stock to a charity, and the stock is worth $1 million, I get $1 million donation, even though I might have bought that stock for $100, and all of that gain that accrued while I own that stock. If I sold the stock, I would have to pay tax on all of that gain. I got richer and richer and richer and richer. Never had to pay tax on it. You pay tax when you sell the stock. But if you give it to a charity, you don't pay tax on any of that gain, and you get the deduction at the full amount. So there's a way in which that's a kind of double benefit. It's very valuable, makes it much better if you have wealth built up over time in property, then it's much better to give the property rather than to give cash to a charity. Okay. So if that property is publicly traded stock, then this rule applies whether you're a public charity or a private foundation. Both, it's the same rule. But if that property is basically anything else, and in the paper I kind of struggle to decide what to call it. Sometimes I call it illiquid property because it is harder to sell than publicly traded stock. But, illiquid property, one of the things that's nice about publicly traded stock is we know exactly what it's worth. Like we have these public markets, it's sold on these public markets. We know every nanosecond what people are paying for it. So we know what it's worth. Whereas most other property, we don't totally know what it's worth. The taxpayer has to do some process to figure out what it's worth. So all of this other wealth, and that includes real estate, it includes privately held companies, it includes artwork, it includes all sorts of things that especially wealthy people have. If you donate those to a public charity, you get the full donation at fair market value. But if you donate those to a private foundation, you only get to deduct your basis. That is the amount that you bought it for. All of that appreciation, you don't get this double benefit of. So that's actually a big, big difference for some donors. Can you get the better donation? So DAFs they're embedded in a public charity. So a donation to a DAF is a donation to a public charity. And the 2006 Pension Protection Act didn't address this issue. And so it left for DAFs this extra benefit for the donation of illiquid property. And all of the evidence about DAFs are that that's a substantial quantity of what they're getting. They're also getting a bunch of cash. They're also getting a ton of publicly traded stock, which again, that would be the same at a private foundation, but they're also getting a bunch of this kind of illiquid property. And so in that way, the bargain for DAFs is much better than the bargain for private foundations.
Mm-hmm.
There's weirdly, Congress saw fit to impose a stricter regime on certain kinds of self-dealing transactions and what I call what they call non-charitable distributions. So this is deep, deep in the weeds. But if you wanted to make a donation to your charity, to your private foundation or to a public charity, and then use the money that you already donated to pay for things for you and your family, like a trip, to have a meeting, or to pay for your travel or things like that, I call that quasi self-dealing, because legally, if you have a legitimate reason for the directors of your private foundation to get together, you can pay for them to get together. If you want to hire them, if you want to hire your kids to work for your private foundation, you can do that as long as they're genuinely doing some work and you're not overpaying them. You're allowed to do that. DAFs, you're not. DAFs, there's just a prohibition, a very simple, straightforward, clean, but dramatic prohibition on all of those transactions. You cannot give money to a DAF and then use that money sitting in the DAF to pay your kids. You can't use that money to pay for travel to see your kids. You can't use that money for all of these quasi self-dealing. So it's stricter. It got kind of a worse deal in some ways than private foundations. And one of the insights that motivated me to write this paper, and it's not that well supported in the paper. In other words, I describe it, but I don't have a ton of great evidence for it, is the insight that actually these bright lines, these really clear rules that make it harder to use DAFs for self-dealing, I think benefits the DAF market. I think it actually increases the attraction of DAFs for the vast majority of people using those DAFs because it separates out the people who are going to use it for self-dealing purposes. And most people don't want to use it for self-dealing purposes, and they don't want the institution that they trust to be making good rules to keep it clean, so to speak. They don't want it to be some of the DAFs to be used for self-dealing purposes because that impacts their DAF or it impacts their reputation or whatever. So by creating more strict rules, they actually benefit the use of DAFs for these other things. And if you want to have a family meeting or you want to hire your kids, make a private foundation. You're allowed to do it there. It's much more expensive to make a private foundation than it is to use a DAF. And that's the primary benefit of a DAF is like good old-fashioned economic efficiency. You can reduce the administrative costs, which in fact are lost costs in some cases. You can reduce those administrative costs if what you're doing is relatively simple because you have economies of scale and scope in these big organizations creating these little funds. So,
And your recommendation to close the public support loophole of DAFs is just that. You would say that's a bright line rule that will help.
yes, exactly,
And
exactly. If you the existence of this opportunity to use DAFs in an abusive way, I think is bad for the donor advised fund market because the benefit of the donor advised fund market is it has simplified, clear rules to prevent some abusive uses. Now, we're ignoring a whole but there's a lot of people out there who are very concerned about uses that I don't really spend a lot of time talking about in my
yeah,
paper. And I should just say that's not because I don't think those are issues. It's because I've carved out what I think of as the lower hanging fruit for this paper. I'm pretty committed to writing another paper where I deal with these more complicated things, and I'll just preview what they are.
yeah,
The thing that most people who are critics of donor advised funds are critics of is the use of donor, what I call or what Roger Collinvo, who's one of the leaders of this, calls the delayed benefit problem. I call it temporal issues. You can be the other thing that is in the grand bargain of private foundations is private foundations are required to distribute, this is a simplification, 5% of their assets every year to public charities. So they can't just sit on 100% of their assets year after year after year. Donor advised funds are not subject to that distribution requirement. So theoretically, donor advised funds could sit on their assets and just let them grow year after year after year. Theoretically, almost never or never, depending on how you interpret the law, distributing their assets to anyone who's going to do anything with it. And that's a very substantial area of concern for the critics of donor advised funds. I'm not saying they're wrong for sure. I'm saying that's a much more complicated issue. It's a more complicated piece of the grand bargain from 1969. And the question of under what circumstances it should be extended to donor advised funds is also a complicated piece because there's a lot of sitting on assets in public charities. Like if you've ever donated to a university, you're aware that universities have these endowments. And if you went to, the most elite 10 universities in the country, these endowments are very, very large. And this question, well, is that okay or not okay? It's a much more complicated question that comes into a whole lot of different issues. So I'm kind of deferring that. And then the other issue that I don't address, but probably need to and will in the next paper, has to do with the way that the ability to donate anonymously is different in private foundations and in donor advised funds. And the kind of the general story is the 2006 legislation preserved an easier ability for the donor to be anonymous in donor advised funds than in private foundations. But again, it's a much more complicated thing. You can figure out how to be anonymous in a private foundation too, but the regulatory regime is really trying to prevent too much anonymity in the private foundation regime, and it's much easier for donor advised funds to stay anonymous. And there's a question about there's a lot of benefits of anonymity, and there's the potential for anonymity to be used in abusive ways. And pulling those apart is hard, and I don't do it in my paper.
Right. Okay. So I want to push you. I'm just going to push you. Right.
Yeah.
Sounds like you might be moving towards considering those loopholes for which a bright line solution might be helpful to
Yeah.
even benefit charity in whatever form.
Yes.
In other words, I want you to, you've told us you're going to consider the plausibly more sinister
Yeah.
explanations for uses of DAFs in
Yeah.
those ways. And it's worth considering, I guess, would be what
Right.
Right. Okay.
Right. And if you think about like, again, I kind of started with self-dealing because I don't think that there's an argument that self-dealing is a good use. Maybe some of this quasi self-dealing that, you do want to have charitable vehicles in which you can pay your kids. Like maybe that's not abusive. We decided in the 1969 Act that it's not abusive for private foundations to do that. So maybe, but it's not hard for me to say that the benefit of having a sector of the market whose purpose is to provide kind of low cost services to what I call retail donors. And retail donors can be donors with a lot of money, but people who don't want to invest in all of the administrative apparatus to do something more complicated, like control your own private foundation, that it would be okay to say those kinds of uses, you just can't have them in this vehicle. If you want to have them, you have to spend the extra money and the extra compliance costs and hire professionals probably to do them in a private foundation. Now, it'd be better maybe if we had a better rule in the private foundation case. But the argument for bright lines is you create the bright lines and that pushes people who want to do the more complicated stuff into other existing structures. And in this case, that other structure is the private foundation. And then it's a separate question. Do we need to reform the private foundation rules to prevent abuses that we've now pushed into the private foundation sector?
Well, the bright line theory would fit there too, maybe.
Yeah.
Yeah, now you've got a fourth paper in line or a third.
Yeah.
Right. Just to finish up then on the low-hanging fruit of closing the public support loophole, no one's picked that fruit yet. Status of that.
No one has actually all the way picked the fruit yet.
Growing.
So one of the things about this paper is I'm basically advocating for the position that the Treasury took in a notice in 2017. So at this point, that's old news. But they didn't issue proposed regulations. They issued a notice. And the notice describes a way of closing the public support test loophole that I actually think is probably the best, least invasive way of closing the public support test loophole. And basically what it says is the recipient charity, if you're a recipient charity and you get a contribution from a donor advised fund, you need to, just for the purposes of calculating public support, you need to treat that donation as if it comes from the donor advisor. And in most circumstances, that is not hard to do because most distributions out of donor advised funds identify who the donor advisor is, because most people want you to know that it came from me. Like, I've been Leff. It's actually coming from me, even though it's going through, in my case, the Greater New Haven Community Foundation. Like they want to know it. But some donors don't, and they're anonymous. So if a donor is anonymous, obviously the recipient charity can't know how to treat the donation is coming directly from them. So the solution in this proposal is that a charity would have to treat all anonymous donations from a single sponsor as if they came from one person. So you create a fictional person, anonymous, and you count that as if that's one person. And that could create problems for recipient charities if they're getting multiple donations through the same donor advised fund sponsor that are anonymous. They could fail the public support test even though functionally they shouldn't. And in those I think, have got to be very few cases, but I haven't systematically gathered this information. In those cases, they would in effect have the option of saying to the sponsor, do you want to tell the donor that their donation actually is going to flip me into a private foundation? Can they please tell me who they are? Or at least tell me, at least break down each donation into individual blocks associated with some, so there's a solution. So that's the solution that I'm proposing. And that's the solution that was proposed in a notice in 2017. The Treasury has been saying for over 10 years that these things, including the public support test, has been on their priority guidance plan. And that's where the Treasury says, like, these are things that we're really going to think about, we promise, but it's been basically since 2006, and we're still waiting for the proposed regulations for that. Now, I want to be very clear. The Treasury Department has a ton of regulations that Congress has asked it to write, and it wants to be very careful about how it writes those regulations because of the legal environment that we're in related to the kind of changes in administrative law that I'm not an expert about that has to do with regulation. So I'm not blaming the Treasury for not issuing these regulations faster, but that would be plucking the fruit if the Treasury Department actually issued proposed regulations that took the position that they already signaled in 2017, or Congress could do it. And it is basically the same solution. In my paper, I talk about 3 possible solutions, but the one I advocate is this one. And this is also the one that shows up in it's called the Accelerating Charitable Expenditures Act, the ACE Act, which I'm not even sure if it's proposed in this congressional session, but it's been proposed in a bunch of previous years. And it tries to take on this delayed benefit problem in a much more substantial way that is much more politically contentious. I don't know how politics works, but it seems to me if there was a standalone bill called you could call it the Benjamin Leff Act if you wanted to, but the Public Support Test Loophole Act, I don't know what the principled reason not to do it would be, probably.
Yeah. Now, DAF providers kind of objected even to your narrow Leff Act, though.
Yes.
They would say you're changing the terms of the bargain, they would say, and you're no, I'm effectuating the terms of the bargain as originally understood, proposed, passed.
Yeah, I mean, it's very hard to read. So I do in my paper talk about, I just pick one response to that 2017 notice that is objecting, kind of coming from, what I would loosely call the industry. So they don't say that misuse of the public support test is part of the original bargain. Instead, they say that the solution proposed is overly broad, that it would catch up too many innocent actors, and they propose another way of solving the problem. I think that their way of solving the problem leaves too much. In other words, it is much less bright. It's much more complicated than the proposal that the Treasury made that I'm making, and it leaves open some pretty significant ways to still make use of the loophole. But yes, there's not no objection to it. And again, I'm definitely not willing to impute ill motives to these are careful and well thought out responses to regulatory guidance, and I wouldn't want to impute ill motives to them.
Right. Okay.
Though if one wanted to, one could, of course.
It would be plausibly more sinister explanation.
It would be plausibly more sinister. The more you ask me about that, the more happy I am that I chose those particular words.
Okay. I mean, it's descriptive, right? Yeah. Without being cynical itself. Benefit. Well, all right. Unless you have anything further to add, I think we can end there.
Yeah, I mean, I'll add one thing and you can just decide whether to cut it out, because your last question where you ask about bright lines, in this particular thing, you also reference this Bright Lines project related to political communication by charities. And because one of the other areas that I caught caught as an interest is the administration of what we now call the Johnson Amendment. I can't help like responding to that a little bit. So I've written 3 articles about what I think is the right way to solve the problem that I think is created by the way that the Johnson Amendment functions under current law. And here, pretty much no one agrees with me. So unlike arguing for the most obvious solution that the Treasury already thinks is true, in those 3 articles, I argue for something that pretty much everyone I've ever talked to is like, no, I don't know why that's what we're doing.
High hanging.
Anyway, the Bright Lines Project, which is an attempt to refine the treatment of political what would be better called campaign intervention speech or activity by 501c3 organizations, by charities. The Bright Line Project is an attempt to come up with a more administrable, brighter line solution to that problem. The problem is there's a reason why there aren't bright lines in this area. And the reason is, kind of what would be a bright line is if you said like, oh, charities can do anything they want. But if they say the name of the candidate and simultaneously say the word vote or election, then they can't do it. But everything else is fine. Like that would be a nice bright line. And then charities know, oh, don't say vote for Bill Clinton was the case that made it all the way to court. Don't say vote for the candidate. Just say the Democrat is super, super evil.
Yeah.
Make your voice known, and then, oh, great, that's totally permitted. So when you create a bright line, sometimes you create an easy opportunity to avoid it. And the only way to create a bright line that doesn't do that is to err on the side of restricting too much speech. And the problem with that is charities have First Amendment rights, just like you and I do. And it's against the Constitution to err too far on the side of prohibiting their speech. So the Constitution pushes us really far. And so we have to get it pretty right. So if we do a bright line that tries to permit all of the constitutionally protected speech, we're going to also permit a lot of the speech that kind of it would be legitimate to prohibit if we had what we have, which is a facts and circumstance test. So, and the actual Bright Lines Project, if you look at their bright lines, they're the craziest, most complicated bright line, not to cast aspersions on the people who are behind the Bright Lines Project, who all, again, are like brilliant lawyers, much better than me. But it's really complicated. They're bright lines. Like they just don't have a really simple solution because they're trying to get this very hard to draw line, exactly in the right place. So that's my bright lines are very attractive, but they're functionally not able to hit in the exact right place usually. And that means that when we want to hit in the right place, we keep incorporating these facts and circumstances tests.
Mm-hmm. Mm-hmm. Okay, well, thank you so much for doing this with us today, Professor Benjamin Leff.
Thank you. It was really my pleasure. I really appreciate it. And I'm looking forward to watching all the other videos that you have on your site. There's a lot of interesting stuff on there.
Thanks.